In the turbulent currents of global finance, where every shift in currency values, debt burdens, and central bank strategies can reshape entire markets, a striking parallel has emerged that demands careful scrutiny from anyone tracking the trajectory of precious metals. Recent price movements in gold and silver have sparked intense debate among observers, comparing the current phase to earlier cycles. Yet a closer examination reveals distinctions that point toward a far more constructive outlook than some surface-level chart similarities might suggest. What appears at first glance to be a familiar topping pattern from over a decade ago carries fundamentally different underlying forces today, forces rooted in unresolved systemic pressures that were largely contained in previous episodes. Understanding these differences requires stepping beyond pure technical overlays and examining the broader economic chessboard where interventions, debt dynamics, and reserve asset preferences interact in ways that history only partially illuminates. Consider the visual resemblance that has drawn attention. Side by side, the path of silver following its sharp advance in the early part of this year mirrors in certain respects the sequence of lower highs and lower lows that unfolded after the peak in the prior major cycle. Both intervals show a corrective phase after an extended upward thrust, and both settle into a period of consolidation that invites questions about duration and eventual resolution. Yet this surface similarity alone cannot dictate the outcome because markets never operate in isolation from the macro environment that surrounds them. Stripping away short-term noise through an indexing approach that focuses on monthly closing levels relative to the starting point of each decline produces a more revealing picture. At the 6-month mark following the onset of the pullbacks, the percentage declines across the earlier episodes and the present one converge near the same relative depth. This convergence immediately undermines any claim of uniqueness for the more recent historical reference. In fact, the deeper early months of the decline in both the financial crisis period and the current interval share a closer trajectory than the shallower initial drop that characterized the later cycle. Such data forces a reconsideration of which historical analog offers the stronger guide. Expanding the comparison to include gold sharpens the distinction further. Gold has consistently led silver through key phases of recovery and breakout in recent years, just as it did after the severe dislocation of the financial crisis. When the relative performance of gold versus silver is examined across the same indexed windows, the present environment again aligns more closely with the earlier crisis recovery than with the post-peak decline of the subsequent cycle. In that later episode, the 6th month remained negative for the relative relationship, whereas both the crisis period and the current stretch have shown positive relative strength for gold by that same interval. Although the present calendar month remains incomplete, the directional bias already visible reinforces the sense that the analogy to the later topping process is incomplete. Gold's leadership continues to set the stage for silver to follow once the corrective phase exhausts itself, a pattern that is repeated across multiple cycles and remains intact today. These price relationships gain meaning only when placed against the backdrop of the larger forces at work. The financial crisis era began with fractures in the housing sector that rapidly evolved into a broader debt and liquidity emergency requiring coordinated intervention across borders. That sequence eventually spilled into sovereign stress on the European continent, creating a prolonged period of uncertainty that ultimately resolved through extraordinary measures designed to preserve the existing dollar-centered architecture. During those years, significant official sector purchases of United States government obligations from major trading partners helped stabilize the system and allowed markets to regain footing. The subsequent peak in precious metals arrived only after those pressures had begun to ease and after a multi-year advance that reflected both safe haven demand and the residual effects of expansive policy responses. Once the coordinated effort succeeded in containing the immediate threats, metals entered an extended period of consolidation as the urgency faded and capital rotated elsewhere. The present environment differs in critical respects. Cracks have reappeared in the form of acute pressure on a major currency tied to an extraordinarily elevated debt load. Official sector intervention has already occurred, aimed at supporting that currency and thereby protecting the broader network of cross-holdings in government bonds. Such action is not a one-off resolution, but rather an early signal that the underlying imbalances remain unresolved. By encouraging a key holder of substantial dollar-denominated assets to maintain those positions rather than adjust them in response to domestic currency needs, the intervention sends a clear message to other official sector participants. The ability to freely manage large reserve portfolios according to national priorities appears constrained. That perception accelerates the longer-term shift already underway, in which official institutions gradually diversify away from traditional government obligations toward assets that carry no counterparty risk. Gold sits at the center of that diversification process, and recent announcements of renewed accumulation by additional central banks after multi-year pauses confirm the direction of travel. This structural pivot stands in contrast to the earlier cycle in which major powers actively supported the existing system through large-scale purchases of government debt. Today, the incentives have inverted. Rising economic powers that once helped underwrite stability now possess both the capacity and the motivation to reduce dependence on the same framework. A meaningful adjustment in the value of the dollar relative to other currencies and to gold remains a plausible consequence rather than a completed event. Equity markets, meanwhile, continue to trade at elevated valuations relative to underlying economic output exceeding levels seen in prior speculative episodes. Such pricing leaves little margin for error should further stress emerge in any segment of the financial system, whether bonds, currencies, or equities themselves. Historical precedent shows that when equity valuations compress and capital seeks alternative stores of value, precious metals have absorbed significant inflows. That rotation process has only begun to appear on the longer-term charts, and its full expression still lies ahead. Monetary policy expectations have also shifted in response to incoming labor market data that diverged sharply from consensus forecasts. What had been priced as a possible move higher in policy rates has given way to a higher probability of unchanged settings as softer employment figures alter the risk assessment. This recalibration arrives at a moment when September has long been viewed as a potential inflection point for risk assets. Any decision to hold steady rather than tighten further would remove one source of near-term pressure on metals while reinforcing the broader narrative of policy support for financial stability. Combined with the ongoing official sector accumulation of gold and the incomplete resolution of currency and debt, stresses the setup favors eventual upside rather than a prolonged multi-year decline of the sort that followed the earlier peak. The corrective phase already experienced has tested key support zones, yet the larger technical structure remains intact. Silver has cleared multi-decade resistance levels that had constrained prices for an entire generation. Such a break does not typically reverse after only a few months of consolidation, especially when supported by the macro forces described above. Gold continues to exhibit relative strength and has begun to stabilize after its own period of digestion. Any further retests of recent lows should be viewed in the context of accumulation opportunities rather than evidence of a major top. Market participants who maintain disciplined purchasing programs through periods of volatility position themselves to benefit from the next leg higher once the current consolidation resolves. Those who entered at elevated levels earlier in the year can use any remaining weakness to improve average costs while retaining liquidity for additional opportunistic additions. Avoiding leveraged instruments remains prudent, given the potential for sharp two-sided moves during periods of heightened uncertainty. Looking further ahead, the roadmap for both metals continues to point toward higher levels once the present phase concludes. Historical analogs that share the combination of early-stage systemic stress, incomplete policy resolution, and rising official sector demand for gold have produced substantial advances after the initial corrective interval. The current configuration mirrors those conditions more closely than it does the later cycle in which coordinated global efforts had already contained the immediate threats. While short-term geopolitical developments can introduce additional volatility that neither technical patterns nor macro frameworks fully capture, the dominant forces remain constructive. The combination of elevated debt loads across major economies, constrained policy options, and a gradual reorientation of reserve assets creates a supportive backdrop that is still in its early stages. As the calendar advances into the final months of the year, attention will focus on whether equity valuations begin to reflect the underlying fragilities more clearly and whether further official interventions become necessary. Each such episode has historically increased the relative attractiveness of precious metals. Central bank buying continues to provide a structural bid that was far less prominent in earlier decades. The tightening of corrective cycles themselves signals that successive rounds of intervention achieve diminishing returns in sustaining the broader financial architecture. This progressive loss of efficacy implies that future adjustments may arrive more rapidly and with greater force than in past episodes. Consequently, the duration of any consolidation in gold and silver is likely to prove shorter than the multi-year declines that followed previous peaks. Once the underlying problems had been addressed, market structure itself has evolved. The interaction between physical demand from official institutions, industrial users, and private investors creates a more resilient foundation than existed in prior cycles. Supply constraints in the mining sector, compounded by rising production costs, further limit the ability of new material to meet incremental demand during periods of heightened interest. These physical market realities reinforce the price discovery process that unfolds on the futures and over-the-counter markets. When speculative positioning becomes overly one-sided, short covering can amplify upward moves just as forced liquidation can accelerate declines. The present corrective interval has already flushed a portion of the more leveraged exposure, leaving the market better for a position for a sustained advance once conviction returns. Curry dynamics remain central to the outlook. The relationship between the dollar and other major currencies continues to reflect the uneven distribution of debt burdens and growth prospects. Efforts to stabilize one particular exchange rate through coordinated action illustrate the interconnected nature of the system. Yet such stabilization measures cannot eliminate the fundamental imbalances. Over time, the cumulative effect of repeated interventions tends to erode confidence in the ability of policymakers to manage outcomes indefinitely. Gold has historically thrived in environments where that confidence is tested. The present juncture contains many of the same ingredients that fueled earlier advances, even if the precise sequence of catalysts differs. Equity market performance provides another lens through which to view the opportunity. Extended periods of rising valuations supported by abundant liquidity eventually confront the reality of slower growth or tighter financial conditions. When that confrontation occurs, capital seeks assets that offer both scarcity and independence from the credit cycle. Precious metals fulfill that role more effectively than most alternatives. The current elevated readings on long-term valuation metrics leave limited room for disappointment. Any deterioration in economic data or further stress in credit markets would likely accelerate the reallocation process already visible in longer-term relative strength charts. The path forward will not be linear. Periods of renewed strength may be interrupted by temporary setbacks as markets digest new information and as speculative flows adjust. Maintaining a consistent approach to accumulation through these fluctuations has historically produced superior results compared with attempts to time precise turning points. The broader thesis rests on the recognition that the forces driving demand for gold and silver are structural rather than purely cyclical. Official sector diversification, private investor interest in tangible stores of value, and the ongoing expansion of global debt all point in the same direction. These drivers do not reverse quickly even when short-term price action appears challenging. As the present consolidation phase continues to unfold, the evidence increasingly favors the interpretation that this interval more closely resembles the corrective period that preceded a major advance rather than the multi-year decline that followed a completed peak. The combination of relative performance data, macro stress points, official sector behavior, and valuation extremes in competing asset classes supports that conclusion. Participants who remain focused on the longer-term implications of these developments position themselves to navigate the remaining uncertainty with greater clarity. The coming months will provide additional data points against which to test this framework, yet the foundational elements already in place suggest that the more constructive historical analog remains the better guide. Market participants should continue to monitor the evolution of policy expectations, labor market trends, and any further official sector announcements regarding reserve management. Each of these variables interacts with the others to shape the opportunity set for precious metals. The recent shift in rate expectations already illustrates how quickly the consensus can adjust when incoming information diverges from prior assumptions. Similar surprises in other domains could further reinforce the case for higher prices over the intermediate term. In the meantime, the disciplined approach of systematic accumulation through both strength and weakness continues to offer the most reliable path for those seeking exposure to the sector. The interplay between technical structure and fundamental drivers will ultimately determine the timing and magnitude of the next sustained advance. While charts provide valuable context, they cannot fully capture the consequences of policy choices made under pressure or the gradual shift in preferences among the largest holders of reserve assets. By integrating both perspectives, a clearer picture emerges of an environment still in the early stages of a larger transition. That transition favors assets that stand outside the traditional credit and currency hierarchy. Gold and silver occupy precisely that position, and the current corrective phase has done little to alter the longer-term trajectory implied by the surrounding forces. Looking across the full span of the analysis, the weight of evidence continues to tilt toward further upside once the present digestion concludes. The early-stage nature of the systemic pressures, the incomplete character of the policy responses, and the accelerating diversification into monetary metals all distinguish the current setting from the later cycle that resolved into an extended decline. Participants who maintain focus on these distinctions rather than on superficial chart comparisons stand better prepared for the opportunities that lie ahead.